Here we are on section 16.2. Now 16.2 is going to look extremely similar to what we just learned about in 16.1, which is good and bad, but then you're going to be like, but wait, Mrs. Gressel, how is it different? When we take a look at 16.2, we're taking a look at the present value of annuities. Now annuities, when I always hear it, I think of investment and things that people use for retirement. Well, kind of that's what we're looking at, but we have to understand the definition of annuity. Basically, an annuity is a series of equal cash flows. Okay, so anytime you have a type of payment where that payment is going to be the same amount, that can be considered an annuity. And the other one we have, the other term for section 16.2 is the present value of annuity. Basically, that's the amount given at a interest rate that supports the payments of an annuity. So working a little backwards, we're going to be using the same type of math. So let's take a look at this. The present value of an annuity. And this right here, this key spot right here is what makes this an annuity, because on a specific date, we're going through and we're making the same equal payment. So we're saying on December 31st of year 1, $1,000, year 2, $1,000, year 3, year 4. Equal payments. That makes it an annuity. So how did we get these numbers? Well, let's walk through that. Balance on January 1st, 3,170. I'll talk about how we got this number in a little bit. We're going to do that times 10% because that's what they said our interest rate is going to be. So we're going to take 3,170 times 10% is going to give us interest of $317. So now I have to take my balance on January 1st plus my interest is going to give me my prepayment balance of $3,487. So then I'm going to take $3,487 minus my December 1st payment, and that's going to give me my prepayment balance for the next year of $2,487. Did that blow your mind? Let's take a look at it again. So here we have interest, beginning amount times 10% interest. Subtract $1,000 beginning balance. That number goes here, 10%, and keep going down. So at the end of year 4, with a payment here would then give us to 0. So 4 equal payments of 10% interest of $1,000 would give me an annuity for $3,170. Let's keep going. If you're not confused yet, let's take a look at the present value of an annuity for $1. This table looks exactly the same, but notice the heading on the top. Annuity, and again, annuity means equal payments. So what we're going to do is we're going to take that $1,000 that I mentioned before, that we'll take a look at how did we get that $3,170. That seemed like a very random number. Well, period, 4 years. Okay, so we already determined that we're going to make a $1,000 payment. So if I take 1,000, and if I know I need a present value of an annuity of $1, I'm going to multiply that by 3.170, and that's going to give me a present value of an annuity of 3,170. So that's how I picked that original number, and then we broke it backwards from there. Again, the $1,000 times our present value of an annuity gave us that. So how else can we use these numbers? So basically, financial advisors use the present value of an annuity to assist their clients for financial planning decisions. Basically, the most common decision that comes into play is whether or not they have the right amount of money needed to save before their retirement. So what we're going to take a look at is we have two people that want to retire at a certain age. Okay. They project they're going to need $50,000 per year to support themselves. If they assume they can invest their money to yield an 8% rate of return, that's what this family wants to do. So the present value of an 8% annuity at $50,000. Okay, so we have 8%, and we're going to assume that they're going to retire in 25 years. So I have to go through and take 50,000, which is the amount that they say need to have a year, and I'm going to multiply that by 10.675. So the present value of the annuity is got to be 50 $533,750. Okay, so that's how much they have to save in order for them to have that $50,000 for them to be able to retire. Okay. So now let's take a look at the other way that we use to calculate that is going to be for a business. Businesses can use the future value or the present value of an annuity to make decisions about investments in assets. So if we take a look at businesses considering purchasing equipment for $22,000, the company is going to be able to generate cash flows of $5,000 annually over the equipment's 6-year useful life. Management expects to yield a 12% rate of return. Okay, so that's important information. So the first thing is they're going to have a net cash flow of $5,000 annually over the equipment's 6 years useful life. Okay, so 12%, 6 years. I have to use this 4.11. So I'm going to go ahead and get 5,000 times 4.11 is going to give me the present value of the annuity of $20,555. How much did I say that investment was for that equipment? Well, it was going to be $22,000. So if I go through and say, all right, the difference between the two is going to give me a negative net present value of $1,445. Should this company make this decision? No. It's going to give them a negative present value, so that is not a good financial idea for this business to go through and invest in that piece of equipment that would have an annuity, or again, the term of annuity means equal cash payments. So what is the difference between what we did in 16.1 and 16.2? Okay, so you have to make a decision or a rule on which table to use. Are you going to use present value, or are you going to use present value of an annuity? Well, remember, the present value annuity table is going to be used when there are equal periodic net cash flows. If you don't see equal periodic cash flows, then you're just going to use your present value table where it doesn't have to be an equal amount per year. So hopefully that's going to help you to understand how to use your annuity tables for this chapter. Here's our work together 16.2. Basically, we're going to go through and take a look at how to create a schedule that shows the payment of an annuity over a 4-year period. The initial investment is going to be $8,662.76 with an annual payment of $2,500 and an interest rate of 6%. So we need to start with our balance here on January 1st, and that's going to be our initial investment of $8,662.76. Okay? And we talked about our interest. Okay? So our interest is going to be 6%. So if I take 6% of that number, it's going to give me $519.77. How much is my annuity? $2,500. So now I need to take these two numbers, add it up, subtract my annuity, which is going to give me $6,682.53. That number then goes here on balance on year 2. Oops, missed a number. 6682.53. That number, again, we're going to multiply it by our 6% interest, so $6,682.53 times 6% is going to give us interest earned of $400.95. Add those two numbers together, subtract my annuity payment of $2,500, and that's going to give me $4,583.48. That number goes here. Multiply that by our 6% interest. Same payment, that's why it's called an annuity. Multiply that by 2%. And that's what's going to come out there for our schedule to show our annuity payment over that period. So now let's go through and do number 2. Calculate the present value of an annuity of 10 payments of $10,000. Okay, so 10 payments at an interest rate of 8%. So I'm going to go ahead and put in here $10,000. Present value of 10 years at 8% is going to be 6.710. See that number? 8%, 10 years. Okay, multiply that across. Oops. So that is the present value of 10 payments of $10,000 at an interest rate of 8%. Now, that Lambert company, they have some more questions for us that we have to help them decide for their business. They want to purchase equipment costing $75,000, having a 5-year useful life, projected net cash flow investment of $20,000 annual. So that's saying every year they're going to make $20,000. Okay, so that's what makes it an annuity versus 16.1, where we had a different net cash flows each pay period or each year. So our annual net cash flows is $20,000. Okay, present value. So we have 5 years at 10% should be 3.791. Do the math. That should give me $75,820. Initial investment is going to be $75,000. The difference between these two should be $820. So, should they invest it? Was it a positive or negative number? Well, in this case, it was a positive number because it's 820. The example that I gave you in the presentation before was a negative, so they'd say no. So I'm going to say yes, the investment has a positive net present value. So there you go. There is section 16.2. There are several assignments associated with that as well.